We start with, hey, welcome to Spin Out, winner Dave, and we kind
I'm
of,
winner.
your winner.
All right. Well, we're here to demystify venture, minimizing FOMO for VCs through the relationship between GPs and LPs.
Great. In this new series, we're focusing on how LPs assess GPs and how you differentiate yourself. Last week, we dove into the strategic, economic, and structural elements of team alignment. So check out our YouTube channel to understand more about alignment as a GP with the LP.
Great. And today, we're diving into track record, investment strategy, and process. But before getting too far into it, let's do a quick review of the whole series that we're putting together on operational due diligence. Winner, what are some of the topics that we've already covered and what's to come?
Great. So quickly, just big picture here. We've talked about team. We've talked about alignment, especially between the GP and the LP. Today's episode is going to be on the track record and also how the track record relates to your investment strategy and your investment process. And in upcoming episodes, we're going to talk about fund formation, terms, risk management, governance, compliance, accounting and administration, and more.
So, first question, Winner, I got for you. Why do LPs even dig into a track record, investment strategy, and process? Like, what's the point of doing this in operational due diligence?
Yeah. So just to set up the dichotomy again, right? So there's investment diligence, right? So an LP is going to underwrite you as a GP, underwrite your track record in investment diligence, right? And understand your investment performance. In operational due diligence, they're also going to evaluate your track record, but they're doing it with a different lens. So the LP is looking at it mainly from the point of disclosure. So disclosing your track record, it's about starting a conversation. It's about highlighting the corpus of work. What investments have you made, right? It's a starting point for the investment diligence process, but it's also a starting point, an important part of the operational due diligence process. So LPs better understand you and your sophistication as an asset manager, as a fund manager, how you track, how you monitor, how you report to LPs. So it's very important. It's a very important part of the operational due diligence process. So, jumping right in, Dave, why do LPs review track records, and why is it such an important part of this operational due diligence process?
Yeah, so I think we talk about it in three parts, and you hit on the first one right away with disclosure. So first things first, this is a trust exercise. This is an opportunity for you to put your investment history, usually into some sort of Excel or tabular format. You're sharing data with your potential LPs, and so what you share with them, is it accurate? Are you making errors of omission and commission? Are you hiding things? Like, all of that is part of this initial exercise. And so while it may not be stated by the LP, they definitely are going to double check your information to make sure that you're accurately displaying it. But besides just the trust piece, there are two other things that LPs, I think, are going through when they look at your track record. One, on the surface, they actually just want to look at your actual investment history, right? Can you get the data together to share the story of how, when you entered these companies, how they've grown, maybe what they're worth now? Can you do that in a nice, clean, easy to understand, tool? Do you have the applicable experience that you say you are going to do? And does your track record indicate that? Did you invest in companies at the stages you say you invest in? Do you have experience getting deals done and across the line? Were you the lead in some of these rounds or in some of these investments, either within your own firm at a prior experience or amongst all the firms in a syndication for that round? So it's a meaningful tool to help them understand on the surface what's going on in your portfolio, but really it allows them to build a plan, I guess, for deeper and further analysis throughout the due diligence process. And so in that case, you kind of move into like, what's the second part of a track record review, right? So first is just the high level data. The second part is like, who do you co-invest with? How do you make investment decisions? What are your process? By sharing a track record, I can then start to build a plan to do some research on my own against the companies that you've shared in your track record. I can go out and ask some references that you provide. How did you operate inside those deals? How do you operate on the boards? But using this track record, I get to build my plan to go ask those future questions. So it's super helpful for me as an LP.
Yeah, that's a great framework. I think building on the trust piece, it's also a signal to LPs for two things. One, how well do you understand the data and information that needs to be conveyed to LPs? So a lot of things you just said, right? Like, you as a GP need to understand that that's important information to an LP, and you need to report on those things properly. And then secondly, and equally as important, you need to be able to get that information. So understanding what information to report, but also being able to get that information, especially if you are becoming an independent manager and you no longer can rely on your prior firm to gather that information. So what that tells me as an LP, the signal there is you maintain close relationships with your founders, right? You've maintained information channels with prior network and prior relationships so that that could translate right into the current fund that I'm evaluating. And that's really important, right? The understanding what to report, but also like being able to get that information to report.
And I think that's a key piece too. If you're an emerging manager and your track record might be an angel investment track record or in pre-seed deals. And as these companies grow and progress, you may not have all the information rights that larger, more established managers may have. And so you will have to rely on those networks, the soft skills to continue to get the information to report back to your LPs. And that is a critical thing that emerging early stage managers have to do day to day. So proving it out to your track record, yeah, I definitely think that's valuable.
I have another question, Dave. So you're a CFO, you work with emerging managers in terms of disclosures to LPs. What are you thinking about there, right? When you're involved in an operational due diligence process vis-a-vis the LP, how are you thinking about disclosures to LPs? What are other things that we should be thinking about?
Yeah, I think to level set for all managers, not all of us come from the same background, right? So my personal background, I know you probably have some similar overlaps here, but I was classically trained by a big bank in both my series license testing, as well as for CFA and Kaya and other testing. We learned about investment ethics and how to communicate ethically by the kind of rules that are generally accepted by everyone. So I think first is you just want to do this the right way that everybody expects, and that will keep you ethically compliant. So you start there, but you want to be open and honest with your LPs. And that's part of that, right? Being a good fiduciary starts early, but you're going to show the good, the bad, and the ugly, right? So the good is what everybody wants to talk about. These are the clear case studies that show your investment process, the sourcing, picking, winning, and ultimately investing worked, right? But there are investments in all portfolios. And I think LPs understand in venture specifically, we are purchasing risk-adjusted return. There should be risk. There will be some investments that may go bad. And the key there is reporting clearly what happened, learning a lesson and incorporating it and being able to talk about it. Now, the last category is the ugly category. And unfortunately, if it does kind of play into your portfolio, you got to be honest about it. But hopefully through your investment strategy and process, you are showing your LPs you hope to avoid bringing on some of this risk. But, ugly investments are things where there was reputational risk to prior investors from some bad act, or there was something not disclosed by the portfolio founders up through, and they want to see how you as a manager react to those. So I think it's really important that when you're building out your track record, you think about the good, the bad, and the ugly, and just being very transparent and ethical as you're reporting this.
Yeah, to respond to that, as the LP, I think there's a few risks that you're trying to understand when you're evaluating the track record, right? One could be operational risk at your firm's level. So if you don't have a CFO, if you're, again, not collecting the right information, if you're reporting, right, could kind of jump another few levels. That's operational risk at your company's level. The other operational risk there is at your underlying company, underlying portfolio level, right? So again, do you know what's going on at your companies? Because as an LP, that's a risk of mine as well, like indirectly, but that is a risk of mine. Like if you don't understand what's going on at your companies and can't manage that or influence that or control that, that's another operational risk. Then there's the reputational risk, right? Where, from a track record standpoint, what's in your portfolio? What are the headlines associated with that? Are they positive? Are they negative? A lot of LPs are going to perform that level of diligence and kind of understand what the reputational risk is there. And then I think the last point, which you touched on, is the fiduciary duty, right? Of like operating in the LP's best interests. Like to reiterate that is super important, right? And I think as long as, you're understanding these kind of de facto ways to engage, like as the GP in relation to the LP, like understanding, what your duties are as a GP are very important. And I think, again, it starts with kind of the proper disclosures with track record.
Well, Winner, we've gone through many different ODD processes with a lot of different emerging managers. Without being too specific here, are there any red flags that you've seen some managers make historically that if we could save future generations from making these same mistakes, we should just go ahead and call them out. Red flags related to presentation, your track record, how you go through it with your LPs during fundraising.
Yeah, I don't know if I'd call them red flags to start, but again, we kind of touched on a few of them, right? I'd call them yellow flags to start. So again, do you have the right information collected, right? If you share with me a track record that just has names of companies, right? That's not enough. It needs to be the name of the company. It needs to be like who's managing that company, the names of the C-suite and the CEO. It needs to be, transaction details. It needs to be valuation information, right? There's kind of like having the list. It's like having a list and then having an actual like report. Those are two very different things. So if you don't have enough of the right data, or it's just sparse when you share with me something, there's a yellow flag there. And you're making me as the LP having to do more work. And sometimes that will just lead to, decision paralysis, or, the LP might deprioritize kind of the effort on evaluating your fund. So if there's not enough data, if there's not enough information, that is a yellow flag. Another, I think, yellow flag is, it's just your understanding of this process, like this distinction between investment diligence and operational due diligence, right? Like if you understand ODD, operational due diligence, I think you can manage the process better of what the LP is trying to understand. And we mentioned, again, operational risks. I'm looking at you now as a manager and what you're going to do in the future. So again, do you know the implications here of this part of the process where it's like, yeah, I've built a track record. I've built these investment processes. I'm going to continue on, executing on that investment process and making sure you're communicating that properly with the LP. It can be a yellow flag, right? Like if I'm trying to dig into this process and I'm not, understanding those risks and you're not qualifying those risks properly. But if you're kind of hand-holding my way through that, helping me understand, how the track record has helped you develop a very sound investment process and how you're going to carry forward with that great investment process, over the next fund cycle, that could be a yellow flag that turns into a green flag. Vice versa, it could be a yellow flag that turns into a red flag.
Yeah, absolutely. And I think one other yellow flag area that I've come across is with investors who are part of a team or were maybe junior before and are moving up and starting their own firm. And you have to be clear to the LPs what your role is and what some of the deals are on your track record. And I think LPs understand that, you aren't the superstar leading every deal, but that you're growing and evolving as a manager through your career to get to this point. And so I think it's also important to make sure that you're being clear about not claiming too much credit when you shouldn't, and being very transparent about when things were team decisions and were team execution, that kind of thing.
So Dave, I want to ask one more question. And that is, we mentioned at the beginning of this episode that we're going to connect track record to strategy and process. So as the CFO in charge of all the operations of a firm, how do you relate kind of the track record that we're talking about in the operational due diligence process to your investment strategy and to your investment process?
Yeah, absolutely. So, I mean, the first caveat we start out up front is every plan will eventually get changed, but you need to have a plan in order to understand the impacts of those changes. And I think what your track record is at least for LPs is it's a way for us to try to make that determination. You had a plan when you raised your funds or you started your investment process as an angel. Like you had a thesis, you had a hypothesis. And what you're coming back to us with now is some sort of proof that you said you would do it. You did what you said you were going to do. And so when I look at a track record for a firm or for an investor that's already been investing, at the stage or at the kind of deals that they're attempting to raise a fund for now, I want to use your track record to validate what you tell me is your investment process. When you tell us what you're planning to do for portfolio construction and all those pieces, that's helpful. But do you stick to it? Do you have the tools and the process to make sure that you're going to follow through on that? And so as a CFO, I will look at the track record, and some of my questions may be more operational than say the principals leading an investment into the fund. They want to know about the investment piece. I want to see proof that you've got investment committee voting, that you've got investment memos, that you've got all these other pieces. And so I will use your track record to identify where I think there might be the best opportunity to kind of follow in, dig in, and I can learn the most about how you relate your process to the results I see on the page. And so for me, it definitely is a tool, and I try to think differently than other people in the assessment process to make sure I'm covering that piece of it.
All right, let's transition to our Did You See portion of the episode.
Yeah, absolutely. So continuing on with the several DIG-UCs we've had over the last couple of weeks, we're seeing more evidence that liquidity is coming back into the venture ecosystem. And so a couple of things caught my eye over the last week or so. One, Deal announced a huge new round. They kind of shared some of the revenue metrics. They raised at a $17 billion valuation and $300 million round. So that was an indicator that there is big deals happening and that companies that do have the metrics are able to kind of raise at the upper end. And I think that ties very nicely with the Q2 Carta data that we saw and talked about previously, where you're starting to see a tick up in median TVPI at the later stages, meaning there's a broader kind of liquidity affecting the marketplace at the later stages as more funds are starting to see this markup in TVPI, as they're starting to see kind of follow-on financings happen. The other one that was really interesting to me was a combination of announcements and investments by starting with JP Morgan, where they announced a $1.5 trillion investment facility over the next 10 years, principally into national security, national resiliency, and kind of the critical infrastructure pieces of our economy. And so when you think about how that plays into venture, you see companies like Base Power recently announce $1 billion round to build a factory to build batteries. You've seen a number of the other kind of large defense tech companies come out with recent defense tech and deep tech companies come out with recent funding announcements. And so I think what is generally happening is we're starting to see some liquidity creep back in at the later stages, and eventually, hopefully, it'll come down to the earlier stages as well.
Thanks, Dave. I can corroborate. I think we are seeing a lot more activity in portfolios. We are seeing a lot more markups across emerging manager funds, which is helping on the fundraising front. And the demand is there for liquidity, right? So it's exciting to see these opportunities happening more and more. Hopefully, it is a trend that continues over the next few quarters. So everyone, thanks for coming in for this week's episode of Spin Out, and hope to see you next week.
Yeah, next week we'll be covering fund formation and terms. So look forward to breaking down what is incorporated into your LPA and all those pieces next week.
Bye all.
See ya.